Hey guys, Jay here, smarthelping.com. I am very excited about this financial model. You've got very complex mental model of what's happening here. And we're talking about scaling a business that offers educational courses. It could be in person or online. And I've got really cool revenue assumptions. This thing, it was tough, but it's elegant. It's really nice. And when you start to think about the financials behind an educational courses and all the different logic that needs to go into it so that you can create a forecast that makes sense based on your assumptions, it gets really complex. Um, this model, I'm going to go through each tab. I'll show you how it works. And you will be able to purchase a template and download it in the link in the description box below. Um, and let's get into it. So we start with the company name. I just put Elder Tech just as an example. Maybe you're starting classes for teaching elderly how to use technology. Launch year. This could be any year. You can adjust to whatever. If you do change this year, make sure you adjust the drop downs accordingly. There will be drop downs on various assumption tabs with dates to define the timing of things. You've got the exit month. It could be any time for a full 10-year period. It could be a 5-year forecast, 3-year, or whatever. You can end at any month. And then you can choose to include an exit value on the end month or not with this, yes or no here. And a EBITDA multiple will define that exit value. I'm just going to put it to no for now, but we'll show you some things with this at the end if you do want to include it. You've also got cash sources. So the model itself will solve for the minimum equity required, and you can choose to also fund some of your startup costs with debt. If you don't, the initial project cost will go up, obviously. We'll keep it with debt for now. Investor equity, owner equity, these values will come from the cap table over here. You can fill in investments you're getting from people or raises you're doing, the percentage of shares they're getting. You want to make sure the totals of this plus this always equals 100%. So here in this case, we got 45% coming from all the outside investors, 55% from insiders, and that equals 100. Same with equity contributed. And the overflow, this is just going to show you how much equity is required after you put in all the numbers for your different investors here against the minimum equity requirement of the project. Okay, so we've got that set up. Let's get into the most fun. Now, I'm going to try to explain this to you. It's I sat here for a while explaining it to my wife. It took a while for things to click, but this is the best way to do this. So number one, you've got up to 3 course types that you can configure. Now within a course type, you can offer multiple classes starting at different times over the 10-year period. You can shut these, instead of zeroing out all the assumptions for a given course type, I did make an on-off switch. So if I put off here, these assumptions will no longer work, and you'll see on the executive summary, course type 1, there's no inputs. You can see even on the monthly detail, everything for the course type 1 is cleared out. You don't see anything for variable cost for course type 1 or revenues. Let's turn this back on. Okay, so first you're going to price your course. How much are you paying every time somebody signs up for a course? Or how much are the customers paying you? Here I'm just setting it as $299 per entry. The next part here is the capacity achievement. So let's say, and let's just look at one for now. So we're just going to say we're going to offer one class for course type 1 with a capacity of 25. So this percentage here tells you of that total 25 capacity, how long is it taking you to reach that capacity over time. And you can go up to 36 months, and then after month 36, whatever this is will be applied to the future. And this curve applies dynamically every time you add a new class expansion within a course type. And there's obviously separate assumptions for each course type for their curves and their pricing. Okay, so let's say we're adding one class on April 2023. Okay, so you see monthly detail, April 2023. We're adding this first class here. Total seats available is 25 because this is 25. If I change this to 20 on the monthly detail, you can see, okay, now this is 20. Okay, now here's where things get tricky. So to model this correctly, I needed to distill everything down into a monthly basis. But usually, the way you define how long it takes to complete a course is generally in weeks, and it can be like, say, you're offering a 2-week course, a 6-week, 30-week, whatever. It doesn't matter how many weeks you do. You'll put that number in here. So in this case, I'm offering one class that takes 3 weeks to complete and a max of 20 people. So what does that mean? Well, it means in theory, as I run this over time, every month I'm actually going to be able to complete 1.4 courses. Now, why is that important? It's because people aren't paying you just a monthly fee. You're getting paid, let's say this was a 12-week course. For the full 12 weeks, each person is paying you $299. So in order to get the correct revenue, what we have to do is say, well, what does that mean on a monthly basis? Well, if it's a 12-week course, we don't want to double count the money. We say, okay, 20 people. If the capacity is 20%, then I have 20% of 20 paying $299, and they're completing zero point 0.4 worth of a course every month. So that's how I get to my total, and when I multiply those together, you can see here on the matrix tab, this is how we're doing it. You'll see revenue here based on courses paid for, and that's all running off of these assumptions. It's now let's say your course did last exactly a month. That's fine. What you would do is say, okay, there's an average of 4.33 weeks in a course. If you just divide, 52 weeks in a year divided by 12 months, you get 4.33. In that case, you would be completing one course. It'd take a month to complete a course. Exactly. So then these values will all work on a monthly basis. You can see on the schedule here, you've got 4 people paying you $299. You can see 299 times 4 is your 1197 there, and that's what you're making each month. And then as you increase capacity here, you can see we're going 20%, 30%, 70%. So we're selling more courses, and the revenue is going up. So that's it. That's essentially how all this assumption set is working. If we put this down to, let's say, 2 weeks, now we can actually complete a course. We're selling 2.2 courses a month in theory, if it only takes 2 weeks to complete a course. So now we can say, okay, in a given month, we're selling 2.2 courses to 20 people times whatever utilization that class is at. And this is one class. Now, you could offer 5 classes to start. Okay, no problem. If you offer 5 separate classes, now you're selling a maximum of 10.8 courses a month to 20 potential people. So 20 people in a class, you've got 5 classes, so potentially 100 people are paying you um, for this 2-week course. Okay, and you potentially could offer double. You could offer a little bit more than 2 courses in a given month. Like if you essentially double up. So in a given month, 2 full courses could be completed, and this is where you're going to also do in your schedule. Like if you're offering 5 classes, you could say, okay, I've got an 8 o'clock class. Let's put a 1 for this class 1. It's a Monday, Wednesday, Friday. Then let's say you've got also on a Monday, you'll do a 10 o'clock for class 2 on Monday, Wednesday, Friday. And I did color coding here based on the numbers, so it's easy. Then maybe you'll do an 8 o'clock on your 3rd class on Tuesday, Thursday, Saturday. And you got to make sure your times aren't overlapping. So this is why I did this. You could do maybe another class at noon on Monday, Tuesday, Wednesday. Another one Monday, Tuesday, Wednesday at 2. So you can figure out, okay, here's 5 classes right there. That works. You'll have instructors teaching each class, and you'll define like how much. So this $299 is how much a given person's paying to complete a course, and then the expense assumptions here you can define up to 5 costs that you have every time you complete a course. So that'd be like, what are you paying an instructor to complete one course for a single class? Other materials, you might have other costs every time you have to complete a course. You can enter those there, and that's how we're driving these variable costs that you see here. And they're also going to be on the monthly detail in this section, variable costs. So it's very robust. You could do all kinds of configurations here, large scale, small scale, whatever you want. This will allow you to see the unit economics properly without double counting anything. It's very, very good. I've checked all the logic on here extensively and done a lot of sanity checks just to make sure this is making sense. I did also add a CapEx. So I did 10 potential expansions or slots to configure when you're opening these classes. The reason why they have to be configured separately is because this utilization or capacity curve has to apply dynamically. So let's say if we start classes, this class here, then let's say, I get to around 100% capacity at month 16. So maybe at month 16, I want to start a second class for 20 people. Same course, so it takes 2 weeks to complete. And maybe on this expansion, I don't have to add any rent. Like on the expense assumptions here, if you added rent, you could account for that, like here, rent space 1 through 6, and define the month and when rent starts if you have to open up new locations, if it's in person. Um, and you might have CapEx, one-time CapEx every time you open a new expansion. Or if you don't, maybe you can expand classes here, 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 and then maybe at some point you're going to have to expand your space. You know, maybe on like the 4th expansion. So here you could put a CapEx for that, whatever it might be, one-time cost to get a new classroom going or a new building. You've got a new class in a new building. So it's very dynamic. It could happen on every expansion or maybe every couple. That's fine. And you would just want to make sure on the expenses, if you're renting space, that your rent costs are lining up with your expansions and how many classes you think you can hold in a given space over time. And again, you can check that with your schedule. And I just put like 6 locations here, but you can easily, if you copy and paste these, you can go copy and paste it on the end here if you want more locations to configure. And this doesn't flow anywhere else in the model. This is just for your own use. It's just to visualize um, your class structures in your the timing of it. Okay, so that is pretty much how course type 1, 2, and 3 work. They all function the same, but they're all unique assumptions you can plug in. Again, you could turn them on and off, configure the pricing over time, how long it takes a class to fill up over time for each course type. You can scale out. So if I were to scale this, let's say I add a new class every, maybe I want to add a class every time I get to 70%. So if that takes 11 months, I'd put 11 here. And then this says every 11 months, I'm scaling out classes that are 20 seat size. They're all the same. I'll take 2. And I think in my head, maybe after I've added 5 classes simultaneously, now I need to do another CapEx spend to support these new expansions here. Okay, and that'll all go like in the CapEx here. You can see those two 5,000 amounts I put in here are fixed costs. They'll have depreciation based on useful life and flow through the model accordingly. So yeah, I mean, there's a lot to account for when you're doing educational courses, and you want to account for things properly. This is the best way I've found to do it, so you can either scale to a large operation. It could be a smaller operation with just a couple of classes with different course types, and you don't have to you don't have to use all these inputs if you don't want. You can clear whatever you're not using out. You can always hide rows as well. Like hiding rows is fine, but don't delete rows. That's going to cause problems in the model. Uh, all right, so that's the main meat of this model is the revenue assumptions. We'll go through the rest of it. So schedule, we talked about matrix. This is where all these dynamic assumptions are flowing through. Expense assumptions, these are more for like corporate costs and any fixed costs that you have. You can define the start month, the monthly cost, and then you can adjust that monthly cost over time. You can also include payroll tax and benefits for any items that are relevant, for any employees that you plan on hiring that are going to be paid payroll tax and benefits. Uh, we have costs directly as a percentage of revenue here, and then our 3 sets of course type variable costs that are dynamic based on how many courses are actually being sold over time. Oh, I did forget one thing. So on this, if let's say a course takes 8 weeks to complete, if this is an 8-week course, that means you don't want to adjust your assumptions. You want to make sure you're adjusting it every third month, because month 1 and 2, if a course takes 8 weeks, that's almost 2 months. If you were to say, well, I'm going to increase my capacity in month 2 to say 50%, well, that means that you're now offering, letting more people come into this class halfway through the course, because technically you're only offering, it's once every 8 weeks, so you can't adjust the capacity every month. In this case, it has to be every 2 months you can adjust it. So it'd be 20%, okay. And remember, this is applying dynamically to the start date of each of these tranches of classes you're opening up. This is not just like month 1 is 20% across the model. No, this is month 1 could be, January 2026, could be December 2026, November 2027, whatever this is. So you need to make sure, if it's a long course, let's say it's a 16-week course. So, 16 weeks, you're looking at, 3.5 months. That means that your capacity, if you offer that to these 20 people and you have 20%, these 20% people, 20% of these people will be paying your course fee for these 3 months, and you shouldn't be increasing that. You can increase on month 4, because you're re-upping every, in this case, every 16 weeks you have an adjustment that's happening. Now, if your courses are less than a month, let's say, 2 weeks, 3 weeks, whatever, then it doesn't matter. You could adjust these the capacity achievement curve every month, and that's fine. There's no logical issues with that. But if your courses last longer than a month, you need to be aware of how you're adjusting your capacity in the lifetime of a given class tranche. Okay, so that's that. And I put notes about all this here. You can read these notes. It talks about what I just said. Okay, expense assumptions, startup costs. These are other one-time costs that you won't have anywhere else. If relevant, you could put them here, maybe web design, an app, what have you. Debt schedule, this is where you can define the terms of any debt that you entered on the control tab. And like maybe it's a 20-year term, your interest rate here, payments per year, and the start month of that. Terminal value, we're not including an exit value in this scenario, so this is 0, but if I were to put this to yes, you now got a terminal value. Some of it might be applied to your fixed assets at exit, some might be applied to extraordinary income. That's just a tax thing. You can adjust your taxes here for what's taxed at your regular income tax rate versus capital gains. And that will go against whatever fixed assets you have left after depreciation has been accounted for. And this, if you just put 100%, that means it's all going to go to extraordinary income. Cap table. So here we kind of went over that. You can define, how many shares you're offering. Usually it's just going to be all common, and then you're just defining where you're raising money from or getting money from between outside investors and inside investors relative to the minimum equity required for the project. Monthly detail, here's where you can see granularly what is going on with each class over time. Total classes available, total seats available, your utilization of those seats, utilization rate, total courses sold. So again, here, if I'm offering courses every 2 weeks, you can complete the course in 2 weeks, then I have 4 seats available, but I'm selling 9 courses a month on average. So I have 4 seats that are being used, but they're being, every 2 weeks I can re-up. So that means my actually courses sold is 9 in that case. And there's decimals here. 8.67. Since there's a little bit more than 2 weeks, 2 weeks, 2 weeks, and there's a little bit left on the end, a couple days, so that accounts for that. So over time, you get the correct numbers as you scale this out. Don't be afraid of decimals. That's completely okay. You get the right numbers over the long run when you do it like this, and it's more accurate. Revenue, and then you've got this for each course type. And you can see how the courses start dynamically based on when you decided to enter your first launch date of your first class for a given course type here, and that's dynamic. So if I change this back to, let's say, January, now you can see I've got classes starting in January for course type 1. Consolidated courses, so everything here, total revenue, you've got your variable costs, gross profit, and all this runs through for a max of 10 years. If you wanted to run it for 5 years, you can see here, I'll just adjust this to, let's see, 2023, 4, 5, 6, 2027. And now I look at my annual detail. It's running for 1, 2, 3, 4, 5 years. And everything stops after that. Let's put this back over here. Okay. We have our sales and marketing costs, general administrative, research and development. Cost is a function of total monthly revenue. Total costs, EBITDA, which is earnings before interest, tax, depreciation, amortization. This is essentially your operating profit or loss. Then you've got other costs here, principal, interest, spelling error there, principal, taxes, startup costs, exit proceeds, capex, debt service, or debt proceeds. And you can see at exit, if I were to, let's say this is a 20-year term loan, if I do include the exit value or terminal value, it will automatically pay that debt off. So you can see here's the principal payments here. You got a big one at the end. Then we've got exit proceeds, capex happening, and then cash flow and cumulative cash flow. So this is the cumulative cash flow after each period. This is what's used to figure out the minimum equity required for the project. Okay, so monthly detail, annual detail, same deal but on an annual basis. You got your executive summary, so high level revenue items, expenses, other items, cash flow, and then you got IRR here for the project and for investors and owners perspective. Visualization, so we've got revenue by year, EBITDA by year. Let me switch this back to off so you can see a nice chart on the cash flow, total revenue by course type. Now these are pretty cool visuals here. Total classes available. So this is a good way to just make sense of what your assumptions are, you know, what your story of the business is. So how many classes are being made available over time. The seat capacity, so total seats available versus total seats actually utilized, which will all be based on your capacity achievement curves. And then your utilization rate is the bar chart, bars. And then I also did that same chart for type 1, 2, and 3 individually. So you can see how they scale over time. You can see the annual courses sold by type. You can see the total classes available by type, monthly, total classes available by course type, annually. Let's make this congruent. Course. Okay. And then now we have financial statements. So I have distilled everything down into a 3-statement model. So you've got your income statement, which will have things like depreciation, your taxes, net income over time, income statement annual, balance sheet. So you can see your cash position, fixed assets, accumulated depreciation, debt, investments, retained earnings, and assets will always equal liabilities plus owner's equity. So you can check the math there, make sure everything looks good. So you got your balance sheet monthly, balance sheet annual here. If we hide the fixed assets, you can see it all in one snapshot. Cash flow statement. This is kind of like your uses and sources. So where's all your cash coming from based on operating activities, investing activities, and financing activities. Cash flow statement annual. Now these change if we were to conclude the exit. You'll see on the income statement in the final month, you've now got some taxes there, extraordinary income, which is important for the investor owner equity view to see what that looks like after tax. You also see now on the cash flow statement, there's that, and all this still balances out. Distributions is a discounted cash flow analysis for the project, so you can put in discount rate here, see the net present value, the IRR for the project, and then you can also see that for the investor view and owner view, which is all going to run off the cap table percentage you put in here and the investment amounts. Okay, and then payroll tax and benefits, so we're doing those calculations here. If you've put in a percentage for payroll tax and benefits there, it will show up. Validations, just your dates, which will update as you change the launch year, which affects, drop downs like these here. It'll affect the drop downs for debt, for expense assumptions, and for the revenue assumptions for each start date for the different course types. All right, well, that's all I got for you. This educational courses financial model should be very relevant and useful to large scale operations as well as small scale operations. Also, it could be used probably for fitness classes, all kinds of anything that you're offering a class that takes a certain amount of time and people pay you a fixed fee to attend that the classes for however long the course lasts for. So it's very, very applicable to all kinds of different situations, and it's very complete. Has everything you could ever want for a financial model. Alrighty, well, that's all I got for you on this one. I will offer it at smarthelping.com. It'll be in the industry specific bundle. Individually, I think I'm going to price this one at $75. I'll put it into the probably the services section. It's kind of a tough one because it's actually I'll probably put it in the retail trade section. It could probably fit into a couple different ones though, but we'll put it into the retail trade section. It'll be part of this whole bundle. You could buy it individually as well once I post it up here. And remember, you can buy all the models I've ever built. I've done what you just saw. I've done for all kinds of different businesses. SaaS, recurring revenue, membership model businesses, real estate underwriting tools, industry specific, joint ventures, general business valuation templates, accounting tools, HR management, all sorts of stuff I've built over the years, which I learned after doing, I took every job I could on Upwork in 2015, 16, 17, 18, and just kept learning and learning and learning, figuring out what people valued and how they wanted, financial models built and what was useful to build in Excel. And now you see everything at smarthelping.com. If you want everything, you can click the All Models link here on the sidebar. You can get everything I've ever built for $9.99. Alrighty, I'll see you on the next one, guys. Like and subscribe.